Hey everyone, this is my first go at a client update. It's an opportunity for me to share some information about the business, but also give an outlook into broader economic trends and thoughts and stuff for the future. So um, today I'd like to share a little bit of information about peak financial planning and just give you guys an update on where things are and share my gratitude for your contribution and your participation and partnership in this new business venture of mine, as well as tell a story. And so I'm going to start with the quick updates and then wax poetic and weave the threads of a story that I think is important that we all share in, and have opinions of, and form our own opinions on. So I'm going to just jump right in. Um, Peak financial planning, we're at 22 households, which I'm so grateful. I feel so blessed and rewarded that you all trust me and are willing to embark on this journey with me, and also value my opinion and advice. And I want to always repay that in kind. So again, thank you. Couple just tactical details on my website at thepeakfp.com. There's a client portal live where you can log into your financial plan through Right Capital. It has direct login links on my website, as well as to your altruist investment accounts. And you can find that on peakfp.com in the client portal tab. On top of that, I've been doing this Friday 5 email. It's been kind of a fun exercise, just testing and seeing where it goes, but kind of curating 5 pieces of content, either video or blog or whatever, of interesting, wise industry experts, and sharing information as they relate to the investment markets or economic trends or general trends in our world. And I hope you all have been enjoying that. And leading to this last bullet here, I would very much like your feedback or requests on areas or subject matter experts you'd like to bring in there. If you'd like my opinions of them, or you just want to see them highlighted, or you have suggestions on people who could inform my worldview better, I would love that. So please send me or let me know any subjects or areas you'd like to see touched on that. Couple personal updates just really quickly as well. Next week, in the beginning of May, Amanda and I will be going to Atlanta for our first financial planning and advising conference, which is exciting. I've never been to an industry conference, and we'll see how that goes. We'll make a little trip about it together, but do some learning as well. In July, I'll be sitting for my certified financial planner cumulative exam, and hoping to pass on the first try. And that's been a big commitment, and I'm looking forward to getting that off my plate. And then a personal commitment in October. My friend Steve and I will be doing a marathon, and that'll actually be my first marathon. I've done a bunch of long hiking and days on my feet, but never actually run 26 miles in a row. So doing some training for that, keeping myself fit while I work at a desk, and saying it here because it will help hold me accountable. So how do I introduce the rest of this? The theme of the rest of this client update is the economy and a short history of the economy and what it means for us. And we just finished the holiday of Passover, the Jewish holiday of Passover. And the Jewish holiday of Passover is pretty interesting and unique, and has some carryover to what I'm about to talk about today, which is that the holiday of Passover is actually a holiday where we as participants or family members sit and actually just tell the story of the holiday of Passover. So that's literally the objective of the holiday, is to sit together and tell the story of the Exodus from Egypt. And the reason is because history matters. And the best way to preserve history and remember history and take its lessons and carry them forward is to retell that story over and over and over again, generation by generation, so that important details, are not lost in the in-betweens of the retelling. And so that is my theme for bringing up this story today, which is in the age of social media and technology, things just move so fast that we're not paying attention to what happened before, or recognizing the differences between what's happening now and what has happened in the past. And so I want to weave this web, synthesized through the stories and contributions of subject matter experts in this area. And I'm just weaving it together for all of us to understand how it could inform good decision making on our parts as we're planning for our own independent contributions and reactions and whatever it is that we want to do with our lives. So I'm going to jump right in. So I want to lay the groundwork here by doing a quick explanation of the economy and financial markets, but really specifically financial markets, because all of us are going to try to build our wealth somehow and create financial stability for some unknown point in the future. And the way we're going to do that is with traditional financial tools that are available to us, meaning the financial markets. And so it's important to understand the dynamic that exists here, which is you have a seesaw. And on one side, you have Wall Street and financial services, and they want to offer products and opportunities for investors like you and I to make money. They want to offer those opportunities with as much risk as you're willing to take on and as little disclosures as they can put in, because they're thinking, hey, I'll offer all the opportunities. It's up to you to do your own research and understand what you're getting yourself into. And if you get burned, that's your responsibility. And so if they could, they would go all the way and index in that direction. And the government says, no, 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 no. You can't just offer unlimited risk without making sure people understand it and explain it. So we're going to regulate you, and we're going to limit the amount of risk you can offer in the form of requiring you to put disclosures and disclaimers and take liability upon yourself should the excesses of your offerings be too abusive of the people who would buy them. And there's this constant back and forth. And every boom and every bust cycle reflects that. Wall Street adds new products, they create new offerings, they sell opportunities in companies with less disclosures, whatever. And then people make a lot of money, some, but a lot of people lose a lot of money because they're not informed and they're not educated. And the government steps in and regulates, cuts Wall Street at the knees, and then Wall Street goes and creatively finds new ways to offer things that haven't been very clearly regulated against, and then the cycle happens again. Laying that groundwork. Now let's go on an economic timeline. So let's fast forward to the end of the 90s. And we're going to talk about the housing market, but we're going to talk about debt and the economy as a whole with this really crude graph that I put here of starting from the left side here with subprime mortgages. In the end of the 90s, subprime mortgages become a thing. Subprime mortgage is a bank lending to a buyer who does not have creditworthiness to have satisfied the mortgage requirements in the past. And so what they do is they slacken or loosen up the mortgage requirements and try to offer credit to people who otherwise would not have been creditworthy. And what happens is the banks try to manage their risk by offering this credit, knowing that there's a higher risk of default, that people won't be able to pay their loans. And the way they do this is they come up with this brilliant idea to package a bunch of loans together and distribute the risk across bundles of loans. 10s, 20s, 30s, 50 loans put together so that the risk is shared. And then what they do is they take that bundle and they sell it away to someone else in the form of a mortgage-backed security, which is this second block here. And in the early 2000s, this comes back to bite banks big time. All these new subprime lenders pop up. They make these poor loans to people who are not creditworthy. When the dot-com bubble bursts and the economy goes into recession, predictably, many of these homeowners cannot pay and they foreclose, and these banks go bankrupt. These lenders, let's say, go bankrupt. And so by early 2000s, 2002, 2003, if you're a logical, forward-thinking person, you're thinking, okay, we've learned our lesson, and that won't happen again. We're just going to stick to creditworthy loans. And that would, in hindsight, have been foolish to think that, because logic doesn't always matter. What matters is this pendulum between Wall Street and the government, which is the government didn't fully crack down and regulate where they should have. And Wall Street was able to continue selling these extremely profitable products and passing the risk along to other people. And so what happens is, in the lead up to the great financial crisis in 2008, more and more and more subprime loans are given, to the point where there are eventually loans of this type called a non-amortizing or negative amortization loan, which basically means that someone who cannot afford to pay for a mortgage or doesn't have income to show when they're applying for a loan can get this loan, pay zero interest, and that interest will roll into the principal of that loan some point in the future, a year, 2 years from now. So they can get by owning this home for 2 years without ever paying anything onto the loan. And then they get some balloon or that interest rolls into the principal, and now their payment 2 years from now or 3 years from now, whenever it hits, is something that they just simply can't afford. And so predictably what happens is, as these looser and looser loan options are offered in 2004, 2005, 2006, 2007, at some point they're going to backfire. they're continuing to get bundled into these mortgage-backed securities. They get sold between banks and all these, in high finance and Wall Street in New York. And everyone thinks their risk is distributed and diversified. And what ends up happening, predictably, in 2008 is they weren't diversified, and a bunch of the biggest players in that space go out of business, and the whole country has the worst recession, might even say depression, since the Great Depression in the 20s. And the trend here is history matters. So I'll return to this later, but history matters. So it happened once, we didn't pay attention. It happened again, so much worse that we couldn't help but pay attention. And so I have this picture of the Fed here, and basically the government comes in and they just regulate the industry as a whole. And you'll see where we're headed with this in a second. But the Fed steps in and starts to do quantitative easing and pumps money into the economy, tries to lower interest rates. They're doing everything that's in their power to mitigate the damage caused by the great financial crisis. And what that results in is this picture here on the left, a zooming economy from 2009 or so, 2010 or so, till present, or until January of this year. And the story in there is government handing out money, but not directly to consumers at that point. But they're trying to do everything in their power to keep us from feeling the maximum amount of pain that could have been felt as a result of the great financial crisis, and rightfully so. So fast forward to 2020 and COVID happens. And this has a cascade of effects. The first is the government tries to ease the burden on us as consumers because we're told to stay home and not work or not produce or whatever. Tons of layoffs. And so the government steps in and says, okay, we're going to send direct to consumers stimulus money for the first time in the history of the country. We're going to send everyone a direct check that they can cash and then use. On top of that, we're going to offer PPP loans, and we're going to offer mortgage and rent moratoriums and all sorts of other credit options and student loan pauses. And so what ends up happening is we lose all these jobs in the economy, and we're all told to stay home, but all of a sudden we have this huge inflow of money directly to consumers. It comes in the form of direct money in the check, or the reduction of other expenses we might have had we had to pay our debts that were on pause now. And so what ends up happening is we start to feel artificially wealthy. We forget that these things are on pause and they're temporary. And when I say we, I mean the society as a whole. And I'll talk for the United States here. We forget that these things are just on pause, and that at some point the pause button, the play button, will be pushed again. And so what we do is we use all this new money and buy things. Concurrent with that, and this is the shipping container here, concurrent with that, ports all over the world are shut down. And if you looked at the port of China, port of Beijing or port of Shanghai right now in China, you would see an aerial graph of all of the shipping containers, cargo ships that are moored outside the port because China is shut down, and so they can't load or unload. And it's crazy. And this is basically what it's been like since the beginning of COVID, because everyone's shut down. And so what happens is we have all this new money to spend, and producers have a limited inventory or supply to provide, and they can't get more because supply lines are halted everywhere. And so what this results in is inflation. Too much money to spend, too little inventory, prices start to go up. Things like that lag. So we don't see that at first in 2020, but now we're starting to see that at the end of 2021 and all the way through now in 2022. Now, I'm not of the opinion that inflation is the end all be all and it's going to go hyperinflation and continue on forever. Things will normalize, but there's a secondary current here, which is, while that's happening, like I said, we're forgetting that our lives will return to normal. We're not going to get further stimulus checks. And eventually we're going to have to pay our rents and our mortgages. And eventually we're going to have to pay our student loans back. And eventually, and so on and so forth. You can see where I'm going with that. It's like eventually these things will return to normal. And what that means is we're going to have a squeeze on how much money we actually have to spend. Because we as consumers, there was like an opening of the funnel. We start to feel more and more wealthy because more money comes in. We stop paying other things. And then now we have to start paying our debts, and we're squeezed from the top. And now we get less money from the government. We're squeezed from the bottom. And we funnel off or taper off into the point where we have less and less money to put into the market. On top of that, the Federal Reserve is deciding to raise interest rates because they need to do so in order to counter inflation. And what that means is that the cost of debt gets higher. So not only do we have to start paying back our debts, we also have higher cost or debt carrying expense. And we have to start paying that. And where we'll see that first is in the housing market, and we're seeing that already. Mortgage rates have gone from lows in like the high 2% in last year in August, and to California, you can find 30-year fixed rates that are above 7% now, which is just bonkers. This is April 28th as I'm making this video. It's just insane. And effectively what happens is as interest rates go lower, home prices get higher. That's good for the value of the home, but it's also good for your payment because your payment as a proportion of your monthly income goes down the lower interest rates are. And what happens when interest rates go up is that your payment as a proportion of your income becomes bigger. So you have less disposable income. And what that might look like right now is something like in early 2021, your mortgage, the average mortgage as a percentage of the average United States workers pay might be something like 24%. And as of March, it was something like 30%. So it's creeping up, eating more and more of our income, take-home income. And that just makes homes more unaffordable. And so the lagging result of that is that home prices will go down. But the immediate result is that homes are more expensive to people, and so people buy less. And you can see that trend happening across other areas, not just homes. Where does this lead to? So now it's 2022, and we hit stock market all-time highs in January. And since then, it's been a very choppy market. We've seen the stock market go down. The Nasdaq's down almost 20%, S&P somewhere between 10 and 12, depending on the day. And we just got our first quarter GDP results from today, actually was released, and they were revised down from a positive 1% to a negative 1.4%. And so it's very likely we're headed for a recession and a major market correction. This story from there is what's next? Who knows? We really don't know. But what my thesis here is we're gonna use history to teach us a couple lessons so that we can stay informed and make good decisions. And so I have one last thing I'll explain, and then I'll tap this into like what do we do with this information? So the story up to now is the pendulum back and forth, Wall Street offering new things, Wall Street, the government regulating, and even now leading up to things today, that has been an undercurrent, and I'll explain it. It's not been overt, it's been subvert. Which what I mean by that is, it's not like Wall Street's offering new subprime mortgages or commercial mortgage-backed securities and all these weird terms that in 2008 were analogous with bad Wall Street and they're screwing everyone over. But one of the things we should pay attention to is technology, which is we just have no idea. As humans, we're ignorant of how technology changes things for us. Things change so much quicker now than they ever did in the past. And I'll give a couple examples of that. 20 years ago, there was no access to online brokerage accounts where you or I, as a direct investor, could go online and just like type in Facebook and buy shares of a stock, or type in VTI and buy a Vanguard index fund. Like, it just wasn't possible. You had to go through an intermediary, such as a stockbroker, and they had to. That was actually good friction, because what it did is it was a barrier to entry to the market. It forced people to move slower, make better decisions, and ideally, it would have forced stockbrokers to be more thorough in their investigation of what types of investments were appropriate for the person they were recommending them to. So that's one thing and that Robinhood is a good example of that. Now everybody on their phone with no friction can go and just put money into the market and just buy stuff. And that has actually contributed to the asset inflation, or the crazy meteoric rise of the stock market over the last 12, 13 years, because all of a sudden you have all these new entrants who couldn't put money into the market. Like, if you didn't have $50,000 to invest, you might not have been able to go buy or invest with a financial advisor. But now with $1,000, you can go open a Robinhood account and throw money into the market. So that's one piece. The second is exchange traded funds. So an exchange traded fund is a mutual fund without the fees. And what that does is it makes these funds that track the market more affordable for people like you and I. And it's a form of passive investing where the fund tracks a trend. It doesn't say, hey, these companies are great companies, you want to own them forever because they pass you a bunch of money in the forms of dividends or payouts. It just says, hey, there's a trend here, we're going to invest and it's going to go along with this trend. And that's allowed for what's called passive investing. So it also has reduced friction in the investor sphere, because people don't need to go through this learning curve and break through these barriers in order to make wise investment decisions. They can just very easily log into their Robinhood, log into their Schwab, toss money into an index fund, and follow the trend. And that has worked up until January of this year. And Bitcoin's another good example of that. It's not had quite the same trajectory, but what it is like we just don't know what it means for us. It's like everyone can stand out there and say Bitcoin solves everything and it's the new gold standard or this or that. And while I might have opinions about that, the truth is we just don't really know what that technology means. It's so new. It's a universe upon which a bunch of new technologies will be layered. And so those of us who are not engineers and geniuses are just, we're foolish if we think we understand what it means. And so I want to summarize that by saying the 20th and 21st century has been the era of technology teaching us how ignorant we are as humans. Every time we think we know something, we get slapped in the face and reminded that we don't. And that is evidenced in this pendulum swing between Wall Street and the government, which is we think we understand how the financial services industry works, and then we're taken by surprise and slapped around because we think we know, but 10 years later, Wall Street's ahead of us and the government is behind and they're not it's this balance. And so I want to lead that to some takeaways. So one is the most important thing we can do is understand that history matters and staying informed. And so these are 4 books that talk about the great financial crisis in 2008, Enron in 2000, and the dot-com bubble in 2000, and just the excesses of Wall Street and how they lead to economic issues that affect all of us. They're just good books. Highly recommend them. Pause the video here. They're great reads too, easy to read. But I'm reading these right now in tribute to Passover to keep my memory fresh of like, how did these things happen and what can we take away from that? And so here are the lessons that I would present that we should be paying attention to based on this information. So one is control what we can. So we are in charge of our own destiny. And part of that is like, there's this kind of juxtaposition right here when I say that history matters, which is in the traditional sense, when we say history matters, it means like something like historical performance can kind of predict future performance, so we should do the same thing we saw. But I'm actually saying it's the opposite. What we're seeing from history is that we as humans can never use the past in the last 120 years to effectively predict what will come next, even if we're told we can, because technology changes too quickly. And so if we're actually relying on what past generations did, we're going to get slapped. And the winners are the ones who say, hey, wait, technology is changing super quick. And the options that are available to me are changing super quick. I actually want to introduce more friction into my wealth building strategy because I don't want to move too fast. If I'm doing what everyone else is doing, I'm probably doing it wrong because most people think history will tell us what will work in the future, and they're not paying attention to how the last 100 years have worked, right? And evidence of that is like nobody buys bonds to create wealth anymore. 50 years ago, my grandparents were buying bonds to create wealth. I remember getting bonds from them as gifts. It's like nobody my age, 30, 40, 50, many of us have never had the experience of even buying a bond, like straight up, because it's an antiquated technology. And it's an example of that what worked in the past will not work in the future or may not work in the future. So my call here is control what we can, and we have to be proactive about our approach to building a stable financial future. And that means staying informed, so understanding the past, the pitfalls, trying to understand what the early warning signs look like and what we should be attentive to so we can make wise decisions. And then it means making a plan, having a plan. A plan is like the scaffolding or the bumper lanes in a bowling alley that help you stay within certain guardrails, but still give you enough flexibility to take care of this 4th piece here, which is adapt or die. We need to live by our plan, but we need to understand history enough to know when we start to see the early warning signs of problems. And one of the greatest early warning signs is when we see the mass market following the same direction. And that means the majority of people doing the same thing is usually a good contrary indicator that says, hey, there's too much hype about this. We should be paying attention that something is off here. Anyhow, moving back to this, we want to live by that plan and then adapt based on the new information presented to us. And so that is my my story, pulling from Passover, which is I think about this story all the time. We want to tell this story, think about this story, because we are blinding ourselves willfully if we say, hey, what happened in the past can never happen again, or we can just use the same strategy. Like Wall Street will never act in its best interest again, and they'll always have our best interest again, and so whatever's happening with the markets is covered and safe. Like, Wall Street has its best interest in mind, the government has its best interest in mind, and you and I should have our best interest in mind. And we have to figure out how to navigate that, knowing that Wall Street doesn't have our best interest in mind, and the government doesn't necessarily have our best interest in mind. The way to do that is have a plan, live by the plan, and adopt or die. Steer the course and redirect the course based on staying informed. So I hope that was helpful. I enjoyed telling the story, and we'll certainly be talking about this and what it means for each of your individual strategies and plans going forward. But please send me questions, thoughts, concerns, adjustments. I'm open to feedback. This is my opinion and a synthesis of outside information. But I hope that this was educational, informative, and feels somewhat close to the reality that we're experiencing now. So thank you for your patience and your time, and I'll see you next time I see you.